if you're a real estate investor, you might be missing out on thousands of deductions. Today, I'm going to show you exactly what are the biggest tax write-offs that you might be missing out on, and exactly how to set them up so that you aren't going to be missing out on those deductions. And the last deduction that we're going to go over is one that almost every single real estate investor misses that I work with. I'm Garrett, I'm from Jones Bookkeeping, and I help real estate investors take control of their numbers and using QuickBooks, just so that we can keep everything in line. Using a software like QuickBooks is the best way to do it. If you need help, let me know in the comments. But let's jump right in. So, number one, depreciation. Depreciation lets you deduct part of your property's value every year. It's probably one of the biggest tax benefits in owning real estate. Most people just let their CPA do it at the year's end, but I want to do it mid-year. I want to see how much I am depreciating every year. So what you're going to do is just set up a depreciating expense account in your chart of accounts, and your CPA will give you the annual numbers, so you'll be able to, if it's a straight line depreciation at least, you'll be able to put it in monthly. Post it as a journal entry so your books match your return pretty much. Number two, repairs versus improvements. Repairs are like, you're repairing a faucet that goes out, you're repairing a single window that breaks. Those things are deducted immediately. They're considered expenses, so you'll be able to deduct them the year that they were fixed. Now, on the other hand, improvements or capital improvements, capital expenditures, these add value or extend the life of your property, like a roof or anything that keeps your stuff going, like plumbing, like if you have to redo a whole big old thing of plumbing or something. These are considered capital improvements, and they're going to be depreciated over time, just like the building would be. So make two separate accounts, one for your repairs and maintenance for your expenses, and one under fixed assets for capital improvements. That way you're ready to hand your accountant clean, IRS-friendly accounts or records. Number three, mileage. Mileage and vehicle use. Driving to your rentals and meeting with contractors and all this stuff will add up on miles. You can use an app to track this to differentiate your personal vehicle, if that's what you're using. Differentiate your mileage between personal use and business use. That's just the easiest way to do it. You can set up a mileage expense account and put down everything there. You'll be able to get, I think it's like 60 cents per mile or around there, back on your taxes. Travel, number four is travel. If you travel overnight for your rentals, like if you're scouting deals, if you're meeting your property manager, you can deduct flights, you can deduct hotels, and even meals, but only 50% of the meal can be deducted. You set up a travel real estate category or something in QuickBooks, and always attach receipts on these especially. That way you have good audit-proof records. Number five, the one I was mentioning earlier that almost every real estate investor that I work with forgets, is home office deduction. If you have a dedicated space at home that you use like this, you can write it off as a deduction on your taxes. But the catch is it can't be used for, say, you always work at your dining room table. You can't write off the space that your dining room table's on because you also eat your dinner there or your breakfast or whatever. It needs to be a dedicated space for your office needs. You can create a home office allocation account, then once a year post the total for your CPA that your CPA calculates. This is more of you're gonna measure out your space, tell them that your office is this much by this much, and they'll calculate for you exactly how much you can write off. It's not really a real solid number that you can track or anything. But that is one of the biggest ones that people forget all the time. So the bonus deal for you to add on is try to attach receipts to everything that you're going to want to deduct. Because if you do get audited, they will ask for this stuff. You don't necessarily have to put it in QuickBooks, but there is an option to do that, and then it's really simple to just send that to them, and no harm, no foul. But you can also, put up a deal on your computer to where you're just, sending them a whole file that has all of your receipts and stuff in it. Just try to keep that as organized as possible. But as long as you're not digging through paperwork, like physical paperwork, I think that's the biggest thing that's gonna not be able to fly. But if you want me to set up these categories for you, if you need any help with your bookkeeping, again, I work at Jones Bookkeeping, and I am the owner. So if you need any help, let me know in the comments. We can set up something. My link is in the description as well. You can go to my website and set up a free 30-minute consultation, and we can talk about your business and how your properties are, and if I can help you or not. But the next video we're gonna go over, or the last video we went over, is about class tracking, and we're gonna kind of go into more depth about how you can make your profit and loss statement a lot more visually easier to read by making your profit and loss statement a 3D rather than one-dimensional. And so check that video out up here, and we'll see you there.